The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. And we're having a little bit of technical difficulties, so we're calling in on our cell phones. So if it sounds weird, what can we do? But anyway, we're here. I'm Esther Gulius, the Tax Lady from EG Tax with Chris Fabian. Hello, Christopher.
Hello, Esther.
Okay, so, there's a feedback. It's very interesting. Anyway, we certainly want to help you with your taxes. 8030930, 8030930, star 930 on a cell phone. We certainly want to help you if you have any questions, comments. Give us a jingle, 8030930, star 930 on a cell phone. All right, Chris. I thought I would talk about some unusual things that people should be aware of.
Okay.
And the first one is, how many times have clients say to you, at 17, I can't claim my kid anymore?
About 75% of the time.
Okay, like 75% of the time. And so I wanted to talk about that. Something happens when a child turns 17.
That's right. The child tax credit, they don't get the child tax credit anymore, which is $2,000. They get their dependent credit, so they get it for $500.
Right. And so it's not like you stop claiming your kid, and it's not like you stop getting a break for being the parents of the child, but rather once the child turns 17, the $2,000 child tax credit is eliminated in favor of the other dependent credit. So you still get to claim the children.
Correct.
But it isn't as lucrative.
Right. You lose $1,500.
Right. But now, what happens then when the kid goes to college?
And you get a college credit with maybe they got a free ride, but if they don't have a free ride, then you get the AOTC, which could be up to a $2,500 credit on the federal.
Right. So if a parent thinks that they shouldn't claim their child, that's incorrect thinking.
That's correct. That's incorrect, which is correct.
All right. Anyway, I'm Esther Gulius, the Tax Lady, 8030930, 8030930, star 930 and a cell phone. All right, so that was one thing I want to talk about. The other thing, if you're in the healthcare profession, a lot of people are getting these nursing credits.
Right. The $1,500, $500. I even seen some for $3,000. So, which is a subtraction from New York State because it's federally taxable, but not on New York State. So it could save them anywhere from $50 up to $300.
Right. And so what you do is you back it off. It's a subtraction on the New York State return. So on your W-2, if you're a healthcare worker, on inbox 14, they would have something like HCW or something to that effect. And that's when you would go to the exclusion page of the subtraction page on the state of New York, and it would be a 225 adjustment, right?
Correct.
Okay.
Correct.
So that's another thing I wanted people to know. So this is very interesting what's going on here. But anyway.
We're trying.
All right. What happens when your income's $150,000 or more, and you have rental property, and you have a loss in your rental?
Well, you still get the loss. You just don't get to claim it this year.
Then how can you get a loss if you can't claim it?
It goes to the cloud, I call it. It's a rainy day loss. It just hangs out there in space until your income either drops under the 150 or you sell the property.
Right. Well, here's the thing. There is a workaround with that, isn't there?
Well, if you have no other income and it's your main source is your rental properties, then you're considered a real estate professional. So not a real estate agent. It's somebody who buys and sells properties for clients. This is a real estate professional who takes care of rental properties. So then they're able to claim the loss.
Right. So if you switch from being just a landlord to a real estate professional, then what wasn't deductible and what is suspended, right?
Yep.
That's what the losses are. You can still take those losses. So I have worked now, for instance, in a couple situation. Let's say that you have rental property in Florida, for instance, and you are the breadwinner, maybe making $150,000 a year, but your wife would be interested in doing the management.
Yep.
And she doesn't have a job outside the house, and she's been taking care of the property anyway.
Correct. So
in that situation, she could become the designated real estate professional and then open that up to take the deduction.
Right. Should we try doing a text real fast before we take our first break? Hi, Esther. I just want to confirm that I'm not overlooking any IRS and or New York credits that my 26-year-old single with no children son may be entitled to. I think there may not be based on his income. He is a public school teacher and had about $50K in W-2 wages income and an additional $3K in 1099 in income. He rents his apartment. Wow, this is another novel from last week. This might be the same guy. About $1,200 $3K into a Roth, not a traditional. And the standard deduction does not know about the $300 credit you can take for paying out-of-pocket supplies for his classroom. Is there anything else he may be eligible to take? Thank you.
Whoa, that was like a novel. Okay, so I don't have access to the taxpayer right here. He might have rental losses. Maybe he sold some rental property. Maybe a student loan interest that he would be able to claim. Since he's renting, that doesn't sound like he's going to itemize. So he has this $300 adjustment for his.
Yeah, if he's back in school for his college, for his graduate program.
Right, but it sounds like that's about it, unless he has some other source of income, like rental property or a small business that he's engaged in. It sounds like that would be it for him.
Yep. So.
Okay, a novel. Okay, I'm Esther Golias, the tax lady, here kind of limping along here on WBEN because we were interrupted by the Sabres game and we still haven't come back to full strength. We're hoping to get it fixed, but in the meantime, we're going to take a short break and we'll be back on the other side.
We are family. I got all my sisters with me.
Hey, family and family, we're just having a big broadcast problem here today. So we trust that if you have any questions, you'll give us a call, 803-0930, 803-0930, star 930 on a cell phone. And I'm joined in the studio with Chris Fabian, and this is a completely unique experience.
And we know our voices sound muffled. That could be because how we're doing it, or it could be we're both sick.
We are both sick, not really sick, not really bad sick. Yeah.
Sick.
All right. So 803-0930, 803-0930, star 930 on a cell phone. You can text us at 716-803-0930. But we'd love to hear what you have to say, and we really apologize for what's happening on the broadcast.
Yes.
And again, we just love helping people. If during the week you have questions, you can go to our website at egtax.com, ask the tax lady. I respond to all the emails.
Yep, you do.
I'm not saying that I respond in 5 minutes, but I respond pretty quickly. Okay, let's talk about how many times have you had people say, I think I'm going to move from my traditional to a Roth, and what kind of consequences can that be?
Oh, do I get chills up my back when I hear that? Yes, I do. And we're not saying Roths are bad,
Not at all.
but Roths are, you have to look at your individual situation and see if that is your best move. I think actually during the summer, maybe we're going to have to do a seminar to Roth or not to Roth for people, and we can show the different examples.
So let's get into this. A traditional IRA is deductible now. You're alive now, right?
Yep.
A Roth is never taxed when you take the distribution out when you're ready for retirement. Okay, but in the meantime, you have 30 or 40 years of living. And if you could save $2,000 a year in taxes over 40 years, you're saving $80,000 in taxes. If you do a Roth, and again, we're not against Roth, but if you do a Roth, you get none of that $80,000, so that when you're older, you don't pay taxes. Well, the question would be, are you ever going to pay those taxes? Because quite frankly, the standard deduction is so high, many people, not all, but many people, I would say most people, are never going to have to pay taxes anyway. So you lose the $80,000 up front in favor of something you're going to get no benefit of later. So you have to be really mindful and think about this, because just because you don't pay taxes doesn't mean it's a good deal. And what happens if you do that conversion, Chris?
Well, then say, okay, well, I want to convert my $50,000 to my Roth right now. Okay, well, you have to pay tax on that $50,000 right now. So if you're in the 22% bracket, that's going to cost you
Plus the state.
Yeah, plus the
So
state.
that more like 30%.
Yeah.
So $15,000.
Easily $15,000. That you better have that cash readily available. So you have to be able to recoup that $15,000. Plus, so it may not be the smartest. I've had people just almost have heart attacks in my office when I tell them that.
Right. Well, what I like to do is I like to show them their tax return for this year, and we're just going to plug in that $100,000 conversion. And then they go, oh, my gosh, I'm going to owe almost 50% in taxes. Right.
Right. But sometimes it's too late because they already
did it. Yep.
So then we're screwed. They're screwed. Because they got rid of the recharacterization with Roth and tradition.
Right. Because once you did it, you did it.
Yeah.
You can't undo it, even up till tax deadline. So, and I know you're going to say, but my financial planner said, but your financial planner doesn't know taxes. And I'm going to tell you, with a almost $31,000 standard deduction, there are people that have very low distributions right now from IRAs, maybe $8,000 or $9,000, and their Social Security is not taxable, so they can take $10,000 out of their IRAs tax free right now if they did planning.
Yep. Exactly.
And so we want you to win.
Yes.
All right, I'm Esther.
We want you to win.
Absolutely. I'm Esther Golias, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone. We apologize if we sound like we're underwater or calling from our cell phones, because we are calling from our cell phones. Right, Chris?
That's right.
All right. And so want to also talk about how to handle stock losses against other income. I don't think people understand that either.
No, stock loss.
I had a guy today that said to me, yeah, oh gosh, I hate it that I have to pay these capital gains. And I said, I looked up and I said, and I'm, and I got a bad cold, so it took effort to talk. And I said, well, why? Why do you think that it's bad? And he said, well, capital gains is a lot of money. And I said, actually, if you're in the 15% bracket or lower, it's zero. And he said, zero? I said, it's zero. The capital gains is a big tax savings. I mean, you don't think these politicians who are making the laws, who are investing in the market, didn't think about that,
Yep. Or how about the people who go, oh, I got a big bonus at work, so I sold my losing stocks, so I'm going to offset my bonus. Well,
Right.
it doesn't work that way.
It doesn't work that way. Well, how does it work, Chris?
Because on your losses, well, your gains, you have to pay tax on all your gains, whether if it's $5,000 to $1 million, $2 million, you're going to pay tax on it. On your losses, you're only allowed up to $3,000 per year.
Per year. Right.
So if you lost $50,000 thinking it's going to offset your other income, only $3,000 of it will.
Right. But it can offset capital gain income dollar for dollar.
Right, right.
Right. So if you had capital losses and capital gains, you net them first, then you apply the $3,000.
Yep.
But capital gains are a deal. They're a real deal. I mean, they're much. The maximum you can pay is 20% plus the 3% Medicare tax.
Yes.
You know. So anyway, I'm Esther Gilius, the tax lady from EG Tax. If you're tuning in and you say, "Wow, they sound terrible," you're right. We can't get this thing to work. So we're on our cell phones trying to help you. If you've got any questions, 8030930, 8030930, star 930 in the cell phone. You can text us at 716-8030930. Hi, we got a text that says something is still wrong with the broadcast. You are right. Anyway, I'm Esther Gilius, the tax lady from EG Tax, trying to help you to understand some of the things that you don't understand, because some of these bad thinking can cause you to miss the mark, right? And overpay.
Oh, yeah.
All right, let's see. What else we got here? Oh, another thing that people want to make sure that people know about is volunteer firefighters' pension. How do you handle that if you're a volunteer firefighter?
Well, it's income on the federal as miscellaneous income. And then on the state, it is a subtraction from the income.
Right.
So, and it doesn't go against the first $20,000 either.
Which is really great.
Yep. So it's a good thing for firefighters.
Right. And so that, again, just like the healthcare worker bonus, is another subtraction on the state of New York. So you carry everything over from the federal, but then if you're a firefighter and you got that firefighter's pension, you take the subtraction on page 2 of the New York State return.
Right. I know we had somebody the other day, they were from their sibling lives in Pennsylvania, and they called them and said, "Hey, did you get the $200 credit?" And they're like, "No, what $200 credit?" I mean, so New York is, as much as we complain about New York, they do have certain things out there to benefit a lot of people.
Absolutely, and if you benefit, you really benefit.
Yep.
Right? Yep. The other thing we want to talk about is when people come into our office and they have businesses, we're trying to get people to understand about this BOI FinCEN regulation that just went into effect January the 1st. It is a really important thing, especially if you have a limited liability company, a subchapter S corporation, or a partnership. Why, Chris?
Well, unless you want to pay a $500 a day penalty come next year. That's why it's very important, because these businesses registered with the Department of State. So they registered, we'll say locally, wherever they're from, whether it's New York, Florida, Delaware, Ohio. They registered with the Department of State in that state. They never registered it with the federal government. So now the federal government says, "Hey, wait, we want to know about you too. So please register." So that they want you to register with them as well.
Right, and so when you register, you're really registering with the Financial Crimes Network, and so it can be very intimidating. But the penalty for failure to do this can be $10,000. It's $500 a day till it gets to $10,000. So in 20 days, you already met your mark.
Yep.
So if you're a pre-existing company, subchapter S, partnership, or limited liability company prior to 2024, you got the whole year to register. But if you started your business this year, you only have 90 days from the time you registered. So that would be anybody who started in January, their 90 days would be up.
Yeah. Okay. We got to.
Okay, we're going to take a break for the news. We'll be back on the other side. Thanks for listening.
We are family. I got all my sisters with me.
Hey, this is Esther Golias, the tax lady, coming by telephone because our feed broke. So we apologize if we don't sound like we're crisp as we normally do. I'm joined in studio with Chris Fabian. Hey, Chris.
Hello, Esther.
Okay, so we're talking taxes, 8030930, 8030930, star 930 on the cell phone. You can text us at 716-8030930, and we don't have anything to do with David Bellavia. So the guy on the text, we aren't political. If you don't like Dave, you need to call him. Okay, so we were talking about the BOI FinCEN thing, and that's a really important thing. So that's the name of the website, BOI FinCEN, right?
Yep.
So it's basically benefit of ownership, and you're reporting it to the Financial Crimes Network of the Department of Treasury, and you've got to do it or the penalty is ginormous.
I had a young gentleman who works for a federal government agency, and the other day, and he asked me about it, and he goes, "Oh, that sounds like the federal government getting involved in everybody's business when they don't have to." But
well, I mean, it goes really back to there's FinCEN is also involved in people that have foreign bank accounts, right?
Yep.
I mean, you have to do that report every year as well, the FBAR.
Yep.
So if you have money in a foreign bank account, you have a potential $10,000 fine with the for failure to file a foreign bank account disclosure form. And again, that's what's been said.
Yep. Yeah, it is. It is. So that's, like you said, it's the financial
it's the Financial Crimes Network.
There you go. That's what I was trying to say.
Federal government. Yeah. Okay. And then why should a C corporation move to an S corp?
Well, you've got to look at this. It's, first of all, can they? But or the normal
assuming
person,
they can.
right? The tax benefits, because first of all, a C corp, if it loses money, it's like that rental person we talked about earlier in the show. The loss just hangs out in the cloud. It doesn't go anywhere until they have income. There's no immediate savings. Where an S corp, if it loses money, the shareholders get the loss. So they get the immediate savings right away.
But even better, if it makes money, right?
Yep.
The bottom tax rung is 10%, then 12%, then 20%. The corporation pays a flat rate of 21%. So if you have a relatively young corporation or one with a smaller net profit, you would save maybe 11% of tax liability by switching to an S corp, right?
Right. Yep. So and not you get the 50. Not to mention the company pays 15%, then you pay the 11% or the 15% for dividends.
Right, and that's taxable.
Right.
So so if you have a C corp and you just think it's so hard to do, it's not hard to do, and you really should think about it.
Yes, for sure.
And they're talking about raising the rates on C corps anyway. Again, right?
All crazy.
All right, I'm Esther Golias, the tax lady. We apologize that we sound like we're coming from a tunnel and a tube, but we just had our feed go down, so we're having a hard time getting it back up. I'm joined in studio with Chris Fabian. We have all of our offices open 9 to 9 Monday through Friday, 9 to 5 on Saturday. Our McKinley Mall office is open on Sunday from 9 to 5. Right?
Yes.
All right. Little again, things that people should watch out for. The 1099-K is coming to a home near you, right? The 1099-K form, we ended up kind of buying time with that, but they're definitely coming back in a vengeance.
Oh, yes. I can't. How many clients come in and ask, "What is this 1099-K?" And we tell them, and they're just in shock, you know, but that's your Venmo. I mean, it started off.
Third-party pay.
Right, third-party pay, which in years past, it was just your merchant services. So if you were a business, you took credit cards, that's how your credit card sales got reported to you. Now they're using it for Venmo, PayPal, any other type of payment system where you get transferred money. So if you use Venmo to pay your friends for dinner, or they pay you for dinner, and for 2024, as of right now, it is $5,000, which that sounds like a lot of money, but the way kids, boy, I sound old, the way kids use it nowadays, that's nothing for a 20-some-year-old to get over $5,000 in Venmo.
And here's the thing. The reason it's important is when you get that form, it's got to go on your tax return.
Right.
Even if it's personal, you have to put it on your tax return. And you back it off under another portion of the tax return. So failure to do that, you're going to get a letter and a bill. So it's very important. So if you're somebody that's been doing third-party pays, you might want to rethink it.
Yep.
And change the way that you're doing the electronic transfer. It's easy, but it's trackable.
Right. I mean, I just had a couple in, and they talked about their daughters, and they're like, wait, my daughters have to do this? You know, I see them at dinner all the time. They take their phone out right away and Venmo each other. But I did, and this is the reason why they're doing this, because I had another client was asking me about it. He goes, yeah, one of my friends who's a contractor, he tells people to pay him by Venmo because nobody knows about it. Well, now
yeah,
they're going to know about it. So, you know, people try to under the table, quote unquote.
Right.
Venmo's not under the table anymore.
Right. Well, and the thing is, whenever it's interesting because I just had a client today that was saying that she was thinking of working under the table. I said, look, you get no health benefits. You can't get unemployment. The person that's paying you under the table loses a deduction. It's a temporary position. It's not good, and you should not do it. You know, I mean, under the table income, if you can't figure it out, they're absolutely moving in that direction to eliminate that possibility.
Yeah, so you got to be careful, and you do it right, and you can sleep at night. That's
right.
what I tell my clients. Do you like to sleep at night? I do.
Yeah.
So do it right.
Not too much this time of year.
Yeah.
Right? Okay, I'm Esther Gilius, the tax lady. I guess everybody's given up on us. 8030930, 8030930, star 930 on the cell phone. I'm so sorry that our broadcast was crashed today, so we are calling in to do the broadcast. So,
but we do got a caller.
We have a caller.
We have a caller.
Wow.
We're going to take Rich from Texas.
Hey,
Rich.
Esther.
Hey, Rich.
I just wanted to let you know, my wife and I, lifelong Buffalo residents, and we're in Texas a little more than half the year now. We're permanent residents down here. But we had some estate issues that we had to deal with. We had tax consequences. And John from your Niagara Falls office was just outstanding. Just wanted to pass that on to you.
That's so nice of you. That's so nice.
All the years we've lived there, the many years that I was when I was working on the weekend, I would listen to you. You helped me through a lot of different things. But I said we just want to let you know that we appreciate you and we appreciate your office.
Well, hey, thank you so much, and we're sorry we sound like we're in a tin can.
No. It sounds like you're broadcasting from Mars. Okay.
Well, we almost are. Okay, thanks a lot. All right.
Oh my! I almost went.
Don't hang up the phone. We lose our connection. Anyway, another thing that we should talk about is people that are paying our private pay patients in nursing homes because they're paying a 6% bed tax. Then that bed tax can be refunded to you but only if you fill out the form and send it in.
Right. You have to be a completely full pay. So if Medicaid is involved paying anything, you don't have the bed tax. But if you are writing the full check out to the facility, you will notice it says bed assessment tax.
Right.
And so they are now charging 8% of it. New York State only gives you credit for 6%. So New York State wants to keep some money. Imagine that.
Maybe because we've been telling people to claim the refund, and they're saying, "Gee, we're losing money."
I mean, but you figure.
But now think about that: 6% on $100,000 is $6,000.
Yeah.
I mean, you have that money coming back. So make sure you do the IT 258 and get your money back if you're a private pay patient or your loved one's private pay, and it gets you at least half a month's payment in there.
Yes.
All right. And oh my God, I must have guilted people into calling me. That's not bad. All right, Dave from Lancaster, how can we help you, sir?
Hey, good afternoon. I was just wondering, I see all these advertisements for these CD rates heading close to 5%. I just wondered what the tax implication was on that when the CDs come due, or any thoughts you have on those in general.
All right, so the 5% CD rates, they're absolutely great. I just did a client before broadcast who had $48,000 in interest last year, and he just was dancing all over. Now it's fully taxable on the federal and the state, so you are going to lose if you're in the 20% bracket. Federal and 6% New York State, you're going to lose 26%. But think about it, you still end up with 75% almost of the money. So if you make $30,000, you still end up with 75% of it. That's a whole lot better than nothing. So I think it's wonderful.
Now, I know the CD rates, they go on to like the website comparison charts. They show some 12 months maturity, others like 3 months. Do you get the full amount 3 months versus 12 months, or what's the advantage of like longer versus shorter if they're all around 5%?
So what's happening is these banks are basically fishing for depositors, and based upon their own budgetary needs, some of them are going to get enough depositors by offering six-month CD, whereas an internet bank that doesn't have a brick and mortar might have somebody more skittish, not wanting to maybe take a chance of going online, and so that bank might have to offer a 2-year 5% CD in order to get the investor. I have my money in internet banks, and I have no problem. They're FDIC insured. I know it makes you feel good to drive by and see your bank, but if you can get a longer term for that rate, you should go for it.
And is there any penalty if you have to take the money out for emergency, or do you just lose that interest?
You have to read the fine print and talk to the bank before you place your deposit, because some banks will waive it. Some banks will say you lose 6 months interest. So you have to look at the criteria for each bank, because each bank, depending upon their need for depositors, are going to have different criteria that would say if you break this agreement, this is what's going to happen. There are really good rates though for money markets. Now on a money market rate, you're not guaranteed the number of months that they're going to pay this, but right now they've been paying 4% and 5% on a money market, so you can just take your money out at any time.
Oh, okay. No, that's good to know. Hey, thank you so much. I appreciate it.
All right. Sorry for the tin can sound. Thanks for listening.
No, that's okay.
All right.
That's all right. Take care.
All right.
Bye-bye.
Thanks, Dave. Okay, so I'm Esther Gillius, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side.
We are family. I got all my sisters with me. We are
Well, we're back for the final 10 minutes of the show. EG Tax here, Chris Fabian. Here to help you with your tax needs. 716-803-0930. You got a couple more minutes to give us a call in. We're going to go to Charlie in Williamsville. Hey, Charlie, how can we help you?
Hi there, Mars-based Esther. Earth calling.
Yes, that's going to
I have
happen.
a question.
October 8th. They're going to, yes.
I have a question regarding a property sale that I clocked in 2023. I did some capital improvements in 2023, and then I won't be putting it on. It'll be going on my 2024 tax return. But I'm wondering, the improvements, I'm trying to narrow my capital gains down. Is going to be pretty strong because I've owned the house for about 20 years. And
So this is your personal residence, or is it a rental?
No, it's an income property and I'm just trying to narrow the capital gains. Do I clock it in this year's tax return, the improvements, or add it to next year's, to return? I'm a little bit unsure of myself.
Okay, well, did you collect rent this year?
No.
No,
No,
so
I
it
was,
wasn't that you weren't trying to rent it out.
No.
Okay, so then
I did the improvements, and then I put it up for sale, and then we didn't close until 2024.
Okay, so then all those costs will go on your 2024. None of your capital improvements will go on 2023 because you weren't actively looking for tenants, so you can't take your expenses, but they will help you next year when you sell the property.
Well, it's sold, so I'll have the closing statement and the first closing statements and all that for next year's return. Yeah, then I would take
Right.
I would add those improvements to that return.
Correct. And what I would suggest doing, if you want, is during the summer, come in with your copy of your return for 23 and your depreciation, and we can work up the figures so you know how much you're going to get dinged with next year.
Yeah, I think so. And one last question regarding a 60-plus individual. Should you keep adding money to a Roth IRA? I haven't added to an IRA in a long time. I usually invest outside an IRA. Is it wise to keep adding to a Roth?
Are you still working?
No, I'm basically retired.
Okay. Are you married?
No.
Okay. So if you have no earned income, you can't put any new money in an IRA or a Roth IRA.
Well, the only, if you call it earned income, is from income properties. That's you call that working.
Yeah, that's not considered earned income. That's passive income.
Okay.
No new contributions are allowed.
All right. And then if I don't, and then I don't really need to liquidate those IRAs that I already currently have until I'm 70 or beyond, or is there an age when you? Oh, I have until then. All right, I have a few more years then. Okay, I think you answered my questions. Thank you.
Okay, anytime. And if you want, like I said, you want help during the summer, we'll run the numbers for you.
Well, at least you'll be back from the moon. That'll be great.
There we go. Yes. Thank you, sir.
Thank you.
Have a great day. Okay. And then we got a text here, too. The estate we are in charge of is dragging on, and we did not settle it last year. Do we still have to file a zero return on the estate? As long as there was no income, you don't have to do the estate return. So you will be fine because the government gets what you get, and if they see no income, they know no return. So I've seen some people who want to return just for the record so they can prove to all the other people, hey, this is what it is, but that's personal preference, but you don't have to do it. And we're going to go from Mars to Clarence and talk to Mark. Hey, Mark.
I just felt like I was on Mars I'm sorry, but quick question for you. With the influx of work at home nowadays, my wife's a W-2, I'm an independent contractor, but she makes the lion's share of the money. Do you ever see the government or the tax agency, and I know it's a stupid question, but changing the tax codes for a W-2 employee to write off home business expenses, like office space, utilities, things like that?
Well, they would all, well, first of all, that would mean both parties have to talk to each other and compromise. I don't think that will ever happen in a long time. I don't care what side of the fence you are. Both parties suck. But in the Trump's tax law changes, which are set to expire at the end of this year, he got rid of the W-2 office and home.
Right.
So It's only on New York State. So maybe for 25, they may bring it back if they just let Trump tax laws go away, but nobody's talking about the future. Maybe after the election.
I don't know. They're talking about a lot of things, but nothing important. So, yeah, I totally agree.
Exactly. So, but the one thing, too, is that people don't understand that with getting rid of the office and home for the federal, they also got rid of the AMT, the alternative minimum tax.
Right.
So where some people were able to write off all this money and they were very happy, but then they got hit with an AMT to bring their taxes right back up. So it's like,
well,
it was great.
They also capped what I can write off as far as mortgage and stuff like that. So
on the SALT, your property
taxes and all that. Yeah. So the taxes weren't good for me, but the question really is, companies can write off their physical brick and mortar locations. Why can't a W-2 write off? Because now they're not going to brick and mortar.
It's hard. And that's where we used to say too, some employees should go to their employer and say, give me a $4,000 pay cut, but reimburse me for my home expenses.
I agree, but as a business owner, you don't want that conversation with an employee, but as an employee, you see where it's justified in your mind. I totally agree.
I know it's a hard concept to understand.
Right. Yeah, exactly. So,
yeah.
Well, I appreciate your time this afternoon, and thank you so much, and I hope you have a great day.
Thank you, Mark. Okay. Well, I'm Chris Fabian from EG Tax. We're running out of time here. But just real fast, too, wanted to say charity rollovers. Don't forget those who have to take RMDs. You can directly put your money from an IRA into a charity, and it counts as your RMD. The nice thing about that is it doesn't count as income on your federal return. I showed somebody that earlier this week, and it would have saved them $1,000 by putting $3,000 directly from the IRA to the charity instead of taking a charitable write-off because they couldn't itemize. That's a lot of money you save. So take advantage of these little loopholes. Okay? IRS letters, oh boy, real fast too. Looks like they're gearing up and sending out identity letters. If you get an identity letter from the IRS and it's asking you to verify yourself, you have to verify yourself. The easiest way is to go online. The second option is to do it over the phone. Okay? Unfortunately, we can't help you. Your son or daughter can't help you because if the IRS hears that, they're going to hang up the call. So you have to do it yourself. Okay? Well, again, Chris Fabian signing this from Mars, but EG Tax on Earth is open to help you. Give us a call, 632-7886. We'd love to hear from you. Thank you. Have a great week and happy St. Patty's Day.